open in the red.
Okay, Cameron Brandt is now joining us, the master of flows, right? Global institutional flows. He's director of research at EPFR Global. Cameron, great to have you with us here. Thank you very much. Appreciate you, joining us. So, what's the latest picture from EPFR showing? I mean, the data would have come out for last week. What is it showing?
It is showing considerable uncertainty about where we're going on a broad front, certainly into the first quarter of next year. We're obviously seeing, as we nearly always do, a certain amount of sort of window dressing, tactical position, year-end positioning, which has actually been to India's benefit. Your stock market is one of the few that looks set to end the year with a net gain, and we've been seeing some money move to take advantage of that. In the emerging market space, we're continuing to see a willingness to look past the COVID turmoil in China to the rebound that people are hoping for. So strong flows there. But ironically, supply chain relocation stories also remain popular, and India is part of that, along with Vietnam, the Philippines, and Mexico.
So foreign portfolio investors returned to the Indian markets in the second half of the year, Cameron, with flows of over 95,000 crores that came in from FPIs. I wanted to understand from you what the situation could look like in the early part of 2023, particularly from FPIs into a market like India, not emerging markets on the whole, but particularly for India.
I think India will remain a popular one, but the popularity comes with a sting in the tail. One of the reasons that FIIs like India is it's a liquid market, and you can both get your money in and get it out. So I think that India remains on their radar screens, but given the general market conditions I'm expecting in the first quarter of the coming year, I think you're going to see money coming in, but also going out with fairly big swings until people get a somewhat firmer picture of where the US, European, and global economies are heading.
Do you have a sense, Cameron, of the quantum of flows that are likely to come in versus the quantum of flows that are likely to get out? Because you're speaking of wild swings, etc. I mean, just wanted to get a sense of the magnitude.
It's been fairly routine for us, certainly in the second half of this year, to see fund groups week to week have flows both in and out equivalent to 3, 4, even 5% of their assets under management, which, as you can imagine, can compound pretty quickly if the flows start to move in a single direction. In the emerging market space, there's still a sense that there's some catch-up to be done there. A lot of the money that could come off the table in that space has come off. So I think we will see some sort of testing of bottom. So more likely to see inflows, but of a very nervous kind that could rapidly reverse.
Cameron, there was I think there was a tweet yesterday same time, from Jeff Gundalch, who ran one of the largest bond funds in the US, who was pointing to some issues in bond market funds. I think he was talking about distressed debt. Anything you've noticed, Cameron? There's a Bloomberg story this morning which points to some dislocations, but of course it's all tied to the very sharp rise in the benchmark funds rate in the US. Are you seeing this in flows?
So we're certainly seeing the enthusiasm for high yield debt that was extremely evident when the Fed was in easing mode shift to a very sort of defensive approach with outflows more often than inflows. I think that bond markets may be where we sort of see some of the more painful movements next year. And certainly, though I haven't really seen it in the flows yet, I do expect some more signs of stress. One of the things I've been keeping my eye on is the fact that, in a very broad sense, the major sources of demand for US Treasuries are all less reliable than they were. Obviously, the US Treasury market has had a large price-insensitive buyer of last resort in the Fed for the past decade, but other major places that would buy treasuries on a large scale, the Social Security Trust Fund, the demographics are beginning to roll that over. Private pension funds are starting to pay out to their baby boomers here in growing amounts, and that will require the selling of assets to meet cash flow needs. China, in the past 2 decades, has been a big buyer of US sovereign debt, and the politics of that are much less clear than they were. So I think that there are going to be some ructions in the fixed income markets. We're still seeing QT in the US, and the ECB has said it will start in March. So I would say you should actually be looking beyond just high yield debt.
All right, look beyond high yield debt. Got that. Cameron, pleasure speaking with you. Thanks a lot for joining us on CNBC-TV18, and wishing you and your team a very happy new year. Have a great 2023.
Thank you very much. You too.
All right, well, that's the word coming in on the flow situation. But let's do one thing. Let's take a quick break. On the other side, our team will be with us to help us with some stocks that you can watch out for today.